Okay, so in this chapter, we'll be looking at Chapter 11. So here in Chapter 11, we are looking at corporate reporting and analysis. So one of the first things we're going to have to review here in Chapter 11 is what exactly is a corporation? What does it mean to be in that corporate form of business? And then we're going to look at some of the most common items that our corporations have to deal with that are pretty much specific to this one form of business. And one of those major topics in this chapter will be the issuance of stock. So of course, we'll see all of that as we get into this chapter and much, much more. Now, in this chapter, the first thing we want to look at then is reviewing what a organization actually is. So, or what a corporation is. Because if you remember earlier in the semester, we talked about all different forms of organizations. We talked about sole proprietorships and general partnerships. We talked about limited liability companies. We talked about C corporations. We talked about S corporations. We talked about all kinds of different organizational structures. But in this chapter, the one we are concerned about is this corporate form, or this C corp. Now, there are a couple of pillars that we have to actually be part of the corporate form of organization is that this is an entity that is actually created by law, meaning that the entity is the entity itself under the law. So that if you actually try to sue the company, you're not suing the person, you're suing the company itself, right? The company exists as a separate legal entity, which leads into our second point here, that the existence is separate from the individual owners. And of course, there are certain rights and privileges that come with this form of organization, such as the ability to sell stock, to have voting boards, all these different types of things that we see commonly with our C corporations. Now, when we talk about our C Corps, the ownership that we talk about can be one of two things. It can be either privately held, or we can have what is called a publicly held corporation. Now, privately held corporations are not publicly traded. These are individual, smaller, typically firms that have opted for the corporate organizational structure, but typically are closely held with members of the same family or community, and they don't want a bunch of outside ownership coming in. Now, publicly held companies, on the other hand, are publicly traded. This is the companies that you might see on the New York Stock Exchange. For example, things like Walmart, things like Apple and Amazon, and all of those companies, of course, are publicly held, and they can be bought and sold, at least those shares of those companies, quite freely in the market. So very good. Now, there are some really powerful advantages to this corporate form of business. So the first two we've pretty much talked about already, and we've talked about for sure earlier in the semester. We saw that we had a separate legal entity so that the corporation is separate and distinct from the individual owners, and this gave us what we called limited liability. Now, this was a really powerful concept because it meant that if the business went under, I could lose every penny I ever invested in the business. That is true. But every one of my individual personal assets are safe. So I can't be forced to sell my car or to sell the clothes out of my closet or to move houses or to do anything like that to cover these corporate debts because the corporation and the individual are separate. Now, another item that is a powerful advantage of this form of business is that you now have transferable ownership rights. And this is what we call those shares of stock. So if I want to own part of Walmart, I simply go buy shares in Walmart. If I no longer want to own Walmart, I simply sell my shares in Walmart. It's very easy to do. Now, the continuous life, right, is reaching all the way back to chapter 1 when we talked about this idea that corporations would operate indefinitely, right? And so we talked about that topic or that concept all the way back in chapter 1. Now, the good news here is there's no mutual agency for stockholders. And you say, well, what the heck does that mean? And this is the idea that just because I own one share of stock in Walmart does not mean that I can go around presenting myself as an owner of Walmart and then start binding Walmart to contracts. So just because I own one share in a company that might have 1 million or more shares, yes, technically I do own part of Walmart. That is a true statement, but I certainly don't have enough ownership or influence to actually make business decisions. Those decisions are made by people within the organization, my upper level management, my CEO, my CFO, all those types of people will be the ones binding the company to contracts, not the individual shareholders, unless they also hold those positions within the organization. And of course, here we have easier capital accumulation, and that stems from the fact that I can sell shares of ownership. Now, if you are using, say, a sole proprietorship, you're pretty much limited in your ability to raise funds to your own bank account, the bank, and family and friends, all right, that are willing to just chip in a little bit of money to help you get started. But if you actually opt for the corporate form of business, you can actually sell shares of stock to the investors, and now you can generate cash in that way. Now, the downside here, there's really two big ones at least. The first is that there is a lot of governmental regulation over corporations, so that if you want to have these advantages, we will hold you to a little bit of a higher standard when we look at your reporting and how you handle things. And so there is this enhanced governmental oversight of our C Corps. So we have to be a little bit careful if you're really small and you're opting for this form of business so that you can sell stock. Just be careful what you're getting into, because there's quite a bit of regulation that comes along with this. Now, on top of the actual audit requirements and everything else that go with being a C corporation, just getting that initial designation can be quite time consuming and cumbersome if you don't understand the process. So it might be worth reaching out and getting an accountant or someone to come in and help you walk through that paperwork, or maybe an attorney, but someone to make sure that you're actually setting this thing up correctly. Now, the other downside is perhaps one that we think of more easily, and it is that there is a second level of tax that corporations have to pay. So we all hear about the corporate tax rate that companies pay, and that is the first layer of tax. So let's say, for example, we have a 25% income tax on my corporations. Okay, that's not the current rate, but this video will be around for a while, and so I'm not going to try to keep it to the current rate, because that will of course change over time. So we'll just say for now, we got a nice 25% corporate income tax rate. So $1 out of every $4 of income gets sent off to the government. That's fine. Okay, it makes our math easy for our examples. Now, when we look at corporate taxation, that is only the first level, because the second level comes when you actually take the money out of the corporation. Now, what do we call it when you take money out of a corporation, or when the corporation issues cash, for example, out to its shareholders? Well, this is called a dividend. Now, the corporation won't pay the dividend, but the individual shareholders will. And it's because of the corporate structure of the business. So whenever you're dealing with a C Corp, what you see is that dividend will be paid out to the individual shareholders, and then those shareholders will pay tax at the individual level. So you'll have 2 layers of tax when you opt for this C corporation structure. So you get hit first when the business actually earns the money, and then secondly, when you actually take the money out and distribute it to your individual shareholders in the form of a dividend. So there's this double level of taxation that we have with our C Corps. Now, if we look at something like an S Corp, you don't have this, right? This is a smaller corporation. They have a lot more strict rules on when you can be an S Corp, how it all works. In general, I would advise you not to go down the S Corp route, because if you run afoul of these rules, there are some pretty serious consequences, and they're pretty specific. So normally, if you don't want to go full C Corp, I would just say run with an LLC or something like that. It's probably your best bet. Obviously, individual circumstances may be different, but the most common situation would be to just go ahead and run with that LLC and you'll be fine. But the good news with an S Corp is that there's still only one level of taxation, because an S Corp is considered a pass-through entity. You'll earn the income on your S corporation, but you just file an informational return with the government telling them, here's how much money the company made. Then you actually pull down your share of income to your individual 1040, and that is where you pay the tax. So there's just one layer of tax with the S Corp. With the C Corp, you get that second level of tax, which we don't really like. So there's a little bit more tax involved. Now, when we talk about a corporation or a C Corp, what I need you to think about first really is, how is this structured? Who is in charge? Who hires who? Well, when we talk about corporate governance, this is just the system that we actually see companies being directed and controlled by. So of course, at the very top of this is my stockholders, the people who actually own the company. They of course have the final say. If they don't like the way the CEO is running this, then they can hire new people for the board. They can get a new board in there that will actually hire new people to run the company. But the stockholders, of course, have a very important say in the organization and how it is set up. Now, the stockholders will then hire the board of directors. The board of directors will then hire your president, vice president, and all of the other officers, everyone up in that C-suite, for example, your CEO, your CFO, all those individuals. Then you'll come down and you'll actually have your employees of the corporation. This is your day-to-day workers, right? But this is the general structure of our company. Very good. Now, when we talk about stockholders, there are some basic rights that we normally have. One is that we can vote at stockholders meetings, or you can register to vote as a proxy. So for example, let's say Walmart has their annual stockholder meeting in New York, and I've recently bought 3 shares of Walmart stock. Walmart, let's say for this example, has 1 million shares outstanding. So we look at that, I have 3 shares out of 1 million. Now, not being negative, but I don't think my opinion is going to be very important to the people at that meeting. But there might be someone who has enough stock to actually be heard at this meeting, and they're trying to make it easier to get votes for what they want, and they're trying to save you from having to go to New York to vote in this meeting where you have 3 votes. So what they do is they send you a letter and they ask you if they can vote for you by proxy. And they'll send you a packet that includes all the information, and they'll say, here's what we're wanting to vote for. If you sign that, then they will actually cast your votes as their votes at the meeting, and it builds up more support for their position. So you can vote by proxy by allowing someone else to actually cast your votes for you. Now, you can, of course, then sell your stock. So if you look at the company, you're not happy with what they're doing, you don't think they're handling items correctly in just the day and age that we operate in, you don't think that they are going to be profitable in the future, you think there's a competitor who's about to put them out of business, whatever it is, at any point you can actually sell your stock. Now, the next area here is we can, of course, if we can sell it, we can now purchase additional shares of stock. If dividends are issued, we can actually receive some of those dividends. And if the company goes under, once all of the people who have loaned us money, who actually have debt against the company, right? Once all of them have been paid off, then we might receive a share of the remaining assets at liquidation. But we are last in line. Now, when we look at stock certificates, you'll see something like this. And we'll see that each unit of ownership will be called a share of stock. Now, in truth, you may not always get a paper stock certificate in today's day and age. You may very well just get something online, a digital copy. You may not even get something that looks like this. You may just be told, good, you own X amount of shares. But when we used to do everything by paper, you always were given something like this. And it essentially notated what you owned, how many shares you owned, all those different things. But this stock certificate will serve as proof that the stockholder has purchased the shares. And when the stock is sold, you will sign a transfer endorsement on the back of the stock certificate. Now, this is very similar to, say, the title of a car. If you've ever sold a car, you know that when you actually sell it, you have to sign the title over to the new owner. It's the same kind of thing here with stocks. Now, when we look at capital stock, we see that there are essentially 3 different types of stock that we have to deal with. There's what is called authorized stock, issued stock, and outstanding stock. So the first of these is authorized. I will tell you, when you initially set up your corporation, you want to set up this authorized number to be some astronomically large number that you don't think you'll ever approach. For example, if I were setting up a company, I might set my authorized shares as something like 10 billion shares, right? Because I don't ever want to limit myself on my ability to raise capital through stock. So I want to leave myself that out. It's very difficult to change the amount of authorized shares over the life of the company. I believe you have to actually go back and deal with the articles of incorporation and refile that, which is quite a headache. So we don't want to do that. Make this some astronomically large number that you know you'll never approach, and you'll be fine. Now, that does not mean you have to actually issue all of those shares. It just means that you can issue all of those shares. So imagine if Sam Walton, when he first started Walmart way back, he had decided that this was just going to be a little county store that was never really going to grow up big. It was just going to operate in his small area. And he said when he initially set up Walmart, he said, I'm going to only allow in this authorized section 100 shares of stock. I don't really plan to issue stock. It'll be fine. The company's going to be small. Well, then whenever his company started expanding and he needed to generate more capital, he would not have been able to do it through stock, and it would have limited his options to debt. And at some point, people aren't willing to loan you more money through debt. And now we've got a problem. Your company can't grow because you strangled it through this lack of fundraising capability. So you want to make sure the authorized number is quite large. Now, the issued number is what has actually been issued at any point to our stockholders. Now, the outstanding is what is currently issued. So the difference between issued and outstanding is that issued includes treasury stock, which is stock that we've actually bought back, while outstanding does not. So when we look at stuff with our capital stock, we see things called par value versus our market price. So the par value is what we say is called an arbitrary amount assigned to each share of stock when authorized. Typically, we want our par value to be quite small. The market price is the amount that each share actually sells for in the market. Please note, these two are not the same. Now, there are three different classes of stock. We have what are called par value stock, no par value stock, and stated value stock. Now, we'll talk about those more in just a little bit. Now, stockholders' equity is, of course, where all of this stuff here in Chapter 11 is going to be happening. So we see that we have corporations' equity, and it will consist of, you'll notice, two main types of equity. One is paid in or contributed capital. This is cash and everything else received in exchange for stock. So this is stuff people have actually paid in. The other is retained earnings, which is cumulative income or loss that has not been distributed as dividends, which of course we've seen on and off throughout the entire semester as we've been talking about retained earnings. I believe that we started this discussion all the way back in Chapter 3 when we first looked at closing those temporary accounts, and we saw how they all ran into retained earnings. Now, the next thing that we need to look at are a few of our journal entries. So in this case, we look at issuing par value stock notice at par. So on June 5th, Dillon Snowboards issued 30,000 shares of $10 par value stock for a total of $300,000. To record this transaction, we need to come in and debit cash for the $300,000, the 30,000 shares times $10 per share. Next, we'll come in and we will credit common stock for the same amount, the 30,000 shares times the $10 par value per share, and that will give me this $300,000. Very good. Now, on my next slide, we want to look at what happens if I issue this at a premium. So does anything change? I think we'll find that actually some things do change. So in this case, on June the 5th, we issued our 30,000 shares still of $10 par value stock. But notice here we actually got $12 per share. So this is when my market value was $12, but my par value is only 10. So to record this transaction, I'll come in and I will see a debit to cash. This is, of course, my 30,000 shares times my $12 per share. My common stock here, the amount I'm actually sending into common stock, will of course be my 30,000 shares times my $10 par value per share. So that gives me this 300,000. Now the issue here is, where does this 60,000 come from? So if I actually want to calculate my 60,000, there's basically several ways we can do this. I'll just show you one, right? One of them is to say, well, okay, we actually generated $12 per share, but my par value in this case was $10 per share. So that is a $2 per share difference times, in this case, the 30,000 shares that we actually issued. This gives me $60,000, and that is the amount that I will see coming in for my account paid in capital in excess of par value. Now, the other way to do this is to say, okay, in this case, I recognize that I had cash that I was actually received of $360, but my par value information only comes out to $300,000. And because this only comes out to $300,000, the difference between these two, between my $360 and my $300, then is this $60,000. So if you want to plug it, that is perfectly fine, but it is up to you. I think it is always better to go ahead and redo that calculation. That way, in case you made a mistake somewhere, you got careless, you slipped up on the calculator, you fat fingered a number, whatever it is, you accidentally made a mistake, it will help you catch that. If you just plug this, you will not catch those silly mistakes. So be very careful. Now, For my next slide, we want to come in and we want to look at how this actually looks on my stockholders equity section. So of course, this would be in my balance sheet, this stockholders equity section, and here's what we would see. So we would start in my stockholders equity title. We would then see that I have common stock, of course, my $10 par value for 50,000 shares, authorized. So of course, this is what we could sell, but we actually have sold 30,000 shares that have been issued and are, of course, in this case, still outstanding. So that is what we see here. So the $10 par value times the 30,000 shares that are issued and outstanding is $300,000. We then see that 60,000 coming back in that we just calculated a second ago, giving me my total for my paid-in capital here of $360,000. Adding in my retained earnings of $65,000 will allow me to come down and actually calculate total equity of $425,000. And so that is what we would see in the equity section of my balance sheet in this case. Now, what happens if I have a stock that has no par value? So on June the 5th, Dylan Snowboards issued 1,000 shares of no par value stock for $40 a share. Well, in that case, everything simply runs through common stock. But you'll notice the notation is not just common stock, it is common stock, no par value, very clearly indicating this is the shares of common stock that had no par value assigned. And of course, my credit will be to cash. So very similar, but we don't have that split out with that additional paid-in capital or that paid-in capital in excess of par. Now, for my next piece, what do we do if we are issuing stated value stock? Well, in this case, we see that we issued 1,000 shares, once again, $40 stated value stock for $50 per share. Now, what exactly stated value is, I don't need you to understand, right? That is well beyond the scope of this course. I just need you to understand what the journal entry looks like. And in this case, it's pretty straightforward because it's exactly like what we saw when we issued par value stock. The only difference is the wording at the end. Instead of this saying common stock $40 par value, this will now say common stock $40 stated value. That is it. Everything else here is the same, right? Except one more time, we will have to make that verbiage replacement down here. So instead of paid-in capital in excess of par value common, this is paid-in capital in excess of stated value common. But all we're doing is changing par value to stated value in each location, and that's it. Nothing else has to change. Now, for my next slide, we want to come in and look, and we see, well, what do we do if we issue stock, but we don't receive cash? Well, in this case, it's going to be pretty much exactly what you would expect. So on June the 10th, 4,000 shares of $20 par value stock were sold for land valued at $105,000. So what this is telling me is that my stock, even though the par value is only 20, my market value must have been more than that because I got something worth $105,000. So that $25,000 difference, right? 20 times 4 is 80. 105 minus 80 is 25. That's this 25 that I'm talking about. Must be in excess of par value. So instead of debiting cash, I simply debit whatever I received, in this case, the land for $105,000. I credit common stock for the $80,000, and I'll come in and credit paid-in capital in excess of par value for common stock for that $25,000. Now, what happens if I actually have to pay somebody for work that they've done, but they don't want cash, they want shares of stock? So in this case, we see on June 5th, we issued 600 shares of $15 par value stock for $12,000 of organizing work. So in this case, that would be an expense that I'm dealing with. I didn't receive an asset. I actually received work that was done for me, which is an expense. So I'll debit organizational expenses for $12,000. I'll send through the par value to common stock and the excess to paid-in capital in excess of par value. Now, you say, well, does this ever happen? I say, yes. There's a very popular story. I'm not exactly sure if it is true or not. I believe it is with Google. When Google was first getting started, they had someone come out to paint the mural in their lobby for Google, whatever that is, and they tried to pay the artist, I think, something like $10,000, which was a pretty good payday, most likely, for that artist. Right? I would take it for sure. But this artist was savvy, and he said, no, I don't want to be paid in cash. I actually want shares of stock in Walmart. And Walmart said, fine. So they gave him some shares of stock, equivalent at the time, I'm assuming, to that $10,000 or whatever the amount was that they were trying to pay him. So in this case, at the time, Walmart shares of stock were almost worthless, right? Because they were just getting started. They weren't a very popular company at the time. they hadn't really risen up to this higher level that they now trade at. So he got quite a few shares of stock out of the deal. As time went on and Walmart became more popular and their stock price increased, that $10,000 worth of stock he initially received quickly became worth significantly more. So this can certainly be done. Now, the problem here from the painter's side is if Walmart had not done well, that stock would have very quickly become worth less, right? It would have very quickly cratered down to almost nothing. So it was quite a risk that he took because it could have backfired, but in his case, or in this case, it actually turned out quite well. So it is something that is on the table. It's not something that you see super common, but it does actually happen. And when it does, it can sometimes be very lucrative. Now, way back in chapters 1, 2, and 3, we first started looking at dividends. And you'll recall that back then I told you, I want you to go ahead and put an asterisk in your notes by the way that we do all these dividend calculations and dividend journal entries, because this is not the correct way to do it. It is just a temporary method that the textbook uses until we actually learn how to do this in the future. Well, here we are in the future learning how to properly handle cash dividends. So a cash dividend, of course, will provide a return to the investors and will almost always increase the stock market's value, right? We like to see companies paying dividends. It tends to be a sign of good health. It tends to be a sign of confidence moving forward. And this tends to increase the price of the stock. But everybody isn't able to issue a stock, and everybody certainly doesn't issue a stock. Now, you'll see in this case that the vast majority of companies, right, in this case, about 3/4 of companies do issue a dividend to their common shareholders, while only about 1 in 5 issue a dividend to their preferred shareholders. But what we do see is that most companies issue a dividend of some type, and this is because most of your C Corps, most of those big publicly traded companies, have actually been around long enough to become stable, not to be growing rapidly, and so they actually have some cash to spare, so they use it to boost their stock price by giving you a dividend. Now, if you're looking at a brand new startup technology company, and that technology company in the first year is growing rapidly, and then they turn around and issue a dividend, is that a good sign for a company in this market? Now, in some weird exception, I suppose it could be. But typically, if I see a company in a high growth market that is not well established yet, that is still getting its feet under it, that is still trying to grow and invest, I would not want to see that company issuing a dividend. Because essentially all a dividend is a return of my investment. So if I issued you, or if I invested in your company $100,000 and you turn around and start issuing me dividends, but you're not buying new equipment, you're not investing in the next layer of cutting edge technology, you're not hiring more employees or giving them better training. If you're not focused on growing the company, then you're not going to survive in this cutting edge market that we've put this company in. So I would rather see the company not issue a dividend for several years, maybe many years, make sure they're well established, they're able to rapidly grow at the rate they need to, they're able to meet all of their investment needs. And then once they've done that, if they want to issue a dividend, that's fine. But I typically would not want to see a dividend in a high growth environment from a highly lean company that's trying to grow and improve early on, because they should be reinvesting that money in the company, not just returning it to the shareholders. Now, in order to pay a dividend, your corporation has to actually have two things. One, you typically cannot issue a dividend if the issuance of the dividend would result in you having negative retained earnings. Not necessarily like that year, right? Like it would be a decline in overall retained earnings. That might be okay. But if we're actually taking the total balance of retained earnings and taking it from, say, $100,000 positive to $50,000 negative, that would be a red flag. And typically that is illegal, right? Because what this tends to signal is that the company is not doing well. So they're trying to pay the owners of the company at the risk of not being able to pay their debtors. The government doesn't like this. The bondholders don't like this. The banks don't like this. And typically there are debt covenants regarding all of these types of loans, and they will specifically prohibit this. But this is typically not a positive thing that is not allowed. Now, the other thing you have to actually have, if you want to pay a cash dividend, is you have to actually have the cash to pay the dividend. So you might have plenty of money set aside in retained earnings, but if you don't have the actual cash, you can't pay a cash dividend. Now, when we look at cash dividends, there are 3 dates that you have to understand. You'll notice this is different from earlier in the semester. Earlier in the semester, I just told you to record one journal entry. Here, we will be recording 2 journal entries on 3 dates. So we've got quite a bit more maneuvering we have to do. The first date we have here is the date of declaration. This is when the liability actually gets created. This is when Walmart's CEO walks out to the podium at a press conference and says, we are declaring a dividend that will be paid on X date in this amount. Right at that point, a couple of things happen. The stock price for Walmart has just gone up a little bit because people know that if I own this share of stock on that date, then I will be receiving this dividend, making it immediately more valuable. Now, the date of record is the actual important date for receiving that dividend. If you buy the stock before the date of record, you will be the one actually receiving the cash. But if you buy the stock the day after the date of record, then you will not be receiving the cash. Whoever owned it the day before will be receiving that cash. And of course, the date of payment is when the cash is actually received by the stockholders. Now, here's the way this works. First date, date of declaration, we create a liability. Second date, date of record, right? This is like Santa Claus. We're making a list, we're checking it twice. We want to make sure we have all of our stockholders correct. Who owns this? Who doesn't own it anymore? Right? That is the date of record. We're simply making a list. And because all I'm doing is making a list, there is no journal entry that is required on the date of record. Very popular test question. All of the following dates require journal entries when dealing with dividends, except blah, 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 right? Well, that answer would be the date of record. The date of record is just a list, right? We're figuring out who owns the stock. We do not care about anything before that. We don't care about anything after that. On the date of record, who owned the stock? The date of payment, then, of course, we will have to actually pay that cash out and remove our liability. So let's see how this works. On January 9th, a $1 per share cash dividend is declared on ZTech Inc.'s 5,000 common shares outstanding. The dividend will be paid on February the 1st to stockholders of record on January 22nd. So January 9th, if you want to highlight, underline, do something with that, that is my date of declaration. My January 22nd date down here at the end is my date of record, and my February 1st date is my date of payment. So on January 9th, I will see a journal entry. I need to create a liability for this dividend. So the first thing I do is I come in, I debit retained earnings, reducing retained earnings in the period the dividend is declared. I then credit common dividends payable. Now on January 22nd, there won't be a journal entry because that's simply the date of record. But on February the 1st, I actually need to pay that dividend. So I'll come in, I will debit common dividends payable, removing that liability, bringing it down to 0, and I will credit cash. Now, one thing to mention here is that you'll notice this is declared on the 5,000 common shares outstanding. If I had treasury shares, those I would not be paying the dividend on. I don't pay a dividend to myself, and treasury shares are shares of stock that are owned by the company that issued the stock to begin with. This is when we rebuy or repurchase our own stock. So we would not pay a dividend to the company for that. So those shares never receive a dividend. It is only those shares that are actually outstanding to people outside of the organization. Now, what happens if we have a deficit? So a deficit is, of course, created when a company incurs cumulative losses or pays dividends greater than total profits. So in this case, I'm actually paying a dividend in excess of retained earnings. So this is typically not allowed. It can happen, and you see the effect here. And in this case, it might not be too terrible because we actually do still have some positive equity. So it's not the absolute worst situation we could have, but it's still not good, right? We certainly would not want to see a dividend being issued if it's going to create a deficit in retained earnings. So typically not allowed here. This is what we talked about earlier. Most of your debt covenants forbid this. Most of your bond covenants forbid this. Most governmental regulations forbid this. And so this is incredibly uncommon. But if it does happen, that is what we would see on the face of my financial statements. Now, looking at a stock dividend, we need to understand how a stock dividend works because it is different than a cash dividend. So instead of me issuing cash, I'm going to write a check. If I still want to actually give my shareholders something, I can do what is called a stock dividend. This is a distribution of the corporation's own shares to its stockholders without receiving payment in return. So why can I use a stock dividend, or why might I use a stock dividend? This is typically used to help keep the market price on stock affordable, and this can provide evidence that we are confident the company is doing well. Now, the reason this tends to keep the market price on the stock affordable is because we're putting more stock out there, so it's diluting the price per share, which keeps it in this ideal trading range. Most stock wants to trade around $100, right? If you get too much above that, it becomes difficult for people to buy and sell readily. If you trade too much below that, people start to look at it as an unhealthy company. So we tend to want our stock price somewhere around $100. So if I get this up to say $300, I might want to issue a large stock dividend to actually bring that down. If I have something where I have too much or too little stock outstanding, I can actually do what's called a stock split or a reverse stock split to try to manage those numbers of shares. And so there's a lot a company can do around their stock to try to make it appear the way that the actual market wants it to. Now, there is one company that has never done a stock split or a stock anything, right? That has never issued more shares of stock, I don't believe, at any point in time. And this is from Berkshire Hathaway. So I'm going to go ahead and pull up right now at the time of this recording, Berkshire Hathaway stock price. And let's just see what we have here. So if you want one share of Berkshire Hathaway stock as of March 10th at 1:35 p.m., it will cost you $406,000. So Berkshire Hathaway, to my knowledge, has the highest per share individual stock price ever. And it is because this company has so few shares outstanding that they actually have this ridiculously high price. Now, this is another reason that if anyone ever asks you, if you want one share of stock and they'll give you any share of any company you want to know about Berkshire Hathaway, because that is the one share that you need to be selecting, right? $406,000 for one share of stock. Very, very good. Now, what we see then is there are two different types of stock dividends that we actually have to deal with. The first is what is called a small stock dividend, which is when we distribute less than or equal to 25% of the previously outstanding shares. So if I issue 25% or less of that number of previously outstanding shares, I'll be dealing with a small stock dividend. If I issue more than 25%, then I am dealing with a large stock dividend. Okay? Now, when we actually look at this, the reason I have to be able to identify small or large is because the actual accounting for them are different. So when I'm dealing with a small stock dividend, I see that Quest has 10,000 shares of $10 par value stock outstanding. On 12/31, Quest declared a 10% stock dividend. So at this point, you want to stop and ask yourself, well, what amount is that? Is that a small dividend or a large dividend? Well, in this case, it is 10%. That is less than or equal to 25%. So that is a small stock dividend when the stock was selling for $15 a share. Now, the stock will be distributed to stockholders on January the 20th. So we need to prepare that 12/31 entry. So what I have to do is I come in, I initially reduce retained earnings by the amount of the market price. So the 10,000 shares times the 10% times that $15 trading price. That is $15,000 coming out of retained earnings. Now my credit will be a credit to common stock dividend distributable for 10,000, the 1,000 shares times the $10 par, and the 5,000, of course, will be running through paid-in capital in excess of par value. Now, if I actually want to look at what has happened to my equity after this small stock dividend, you'll notice that there hasn't really been a change. So if I zoom in on this section down here, all I'm noticing is that some stuff has been moved around. But in truth, the actual total for stockholders' equity zeroes out. So before the dividend, I had $100,000 in common stock. Now I've got an extra 10. So this is now 110. But on the date of this, or before I actually issued my dividend, on my date of declaration, I increased common stock dividend distributable by 10. But then when I issued that, that went away. So there was a zero net here. Then I come in and I see that my paid-in capital in excess of par, of course, went up by this 5,000. So there's a $5,000 increase here. But my retained earnings, in this case, came down by 15,000. And so that comes through here. So I have an increase of 10, an increase of 5, and a decrease of 15, netting out to a zero change, showing me that after my small stock dividend, my actual ending stockholders' equity is the same as my beginning stockholders' equity, or my stockholders' equity before this. So this is what we see with a small stock dividend. Very important. The actual small stock dividend itself does not change the total stockholders' equity amount. It just changes the makeup. Now, when we have the date of distribution, let's see what that journal entry looks like. And I think we can pick it out from the table we just saw, but it is a debit to common stock dividend distributable, getting rid of that liability and then crediting common stock for the $10 in par value. Now, does anything change when I deal with a large stock dividend? I bet you can answer that right away, because if there was no difference, why would we make a distinction? So of course there will be a difference. When I'm dealing with a large stock dividend, let's see how this works. In this case, Quest had 10,000 shares of $10 par value stock, and they declared a 30% stock dividend. So this 30% stock dividend is greater than the 25%. And so we are dealing with, once again, a large stock dividend. So the stock will be distributed on January 20th, 2014. Preparing the journal entry on December the 31st will look like what? So we have to come in, we will capitalize retained earnings for the minimum amount required by law. Typically, this is the par value. So when I'm dealing with a large stock dividend, I am using the par value for retained earnings. When I'm using a small stock dividend, you'll remember that that was the market price. So this is why it's so important. So we'll debit retained earnings for the 3,000 additional shares times the $10 par value. That is a $30,000 difference. Now this will create a credit to common stock dividend distributable for $30,000. Now, moving along then, we see that we now have stock splits. So what is a stock split? A stock split is simply whenever I have a certain number of shares and I now want more shares. So I've got 100,000 shares, but I really want 200,000 shares. So what I can do is what's called a 2-for-1 stock split. So if you owned 1 share of stock, congratulations, you now own 2. But what has also just happened is that by doubling the number of shares, I have halved the par value per share. So you'll notice initially 100,000 shares down to 200,000, right? So we've increased, or we've doubled that number of shares. But you'll also notice that at the beginning we had a $20 par value per share, and now we have a $10 par value per share. So this is a stock split. This is done typically to manage my stock price and keep it in that ideal range for my industry. Like we said earlier, typically we like to see things trading around $100. But that's a very general rule. Certain industries may trade well above that, certain industries may trade well below that. But the general common rule is we want something around $100. And so in this case, we appear to have wanted something around $10. That's fine. We can do that. It's a stock split. Now, let's see what we have here. I think this chart is a very good chart for you to use if you have any questions on how all of these different things are working. It will show you what is actually happening in each case, what is changing, what is not changing, what direction things are going. So I think it's very helpful for you. I will not be testing you where I have you, I don't think, recreate this, for example, but certainly be familiar with these ideas, right? So that if I was to give you a question, you could at least reason out and give yourself a good shot at getting the answer right. Once again, not necessary to memorize this by any means, but maybe once you think you really understand these items and their journal entries, then use this table as a way to kind of check to make sure you understand the financial statement picture and what's actually happening on the big scale. Very good. Now, for my next area, we want to look at the characteristics of distributing stock. So we've talked about common stock a fair bit now. Common stock is, of course, the most common, but what common stock does is it gives you the right to vote, right? That is the most powerful part of owning common stock. Almost always, common stock has the right to vote. Certainly, you can have common stock that doesn't have a right to vote, but it's very, very strange. So the most common issue with common stock is that you do have that right to vote. So if you want to stay in the company, you're normally good to go with common stock. But if you don't care about how the company is run necessarily, you just think it's a good company, and you really would like some voting rights, or you really, I'm sorry, don't want voting rights, but you really care more about those dividend distributions, then preferred stock might be the option for you. So when we look at preferred stock, the reason this is preferred is because they have priority when it comes to actually receiving the dividend distributions. And the good news for our preferred stockholders is this will usually have a stated dividend rate, so that if a dividend is ever issued, they will get a certain percentage. But the big downside, typically preferred stock does not have voting rights. Now you can see most companies don't have preferred stock, but some do, so that's fine. Of course, within common stock and preferred stock, you can have different grades or different levels or different classes of stock. So you can have grade A common stock, grade B common stock, grade C common stock, grade A preferred, grade B preferred, right, all the way down. You can have as many of these as you want. Most companies don't have too many, maybe one to three types of common stock, 1 to 3 types of preferred stock, and that's normally good enough for what we need. But this is the way that this typically works. So with preferred stock, you do have that priority when it's time to issue a dividend, or when an issue, goodness gracious, or when a dividend has been issued. Now, on the bright side, what that means is when that dividend gets declared, you will get first rights to it. But do you at any point ever have a right to be issued a dividend? Like, does the company absolutely at any point ever have to issue a dividend? And the answer is no, right? You bought stock, you bought equity. Equity does not have an expiration date. Equity does not have a due date. Equity is never required to be repaid. So even if you buy preferred stocks that's got, say, a 10% dividend, well, that's great. But that only applies if they ever issue a dividend. If they never issue a dividend, you will never see that. So you have to be very careful. Now, along this line, there is a very important feature that you will want if you are buying preferred stock, and it is the feature of being cumulative. So if dividends are cumulative, then dividends in arrears must be paid before dividends may be paid to common shareholders. This is typically the common case. Non-cumulative preferred stock typically will issue a lower price because people are not as thrilled about it. But undeclared dividends from current and prior years do not have to be paid to your preferred shareholders in the future. So in this case, we see that we have $10 par value common stock, 30,000 shares issued and outstanding for $300,000. We have preferred stock, $100 par value times the 50 shares issued and outstanding for $5,000. Paid in capital in excess of par for preferred is $1,000, and we have retained earnings of $65 for total paid in capital of $371. Now, if we have the dividend preference for a preferred stock, we see that the corporation's outstanding stock includes 1,000 shares of $100 9% preferred stock with potential dividends. Notice potential dividends of $9,000 per year. This is the 9% times the $100 par value per share times the 1,000 shares. And of course, we have the 4,000 shares of $50 par value common stock. Now, if the board of directors declared cash dividends of $5,000 in 2019, and in 2020, the board declared cash dividends of $42,000, how does this work? So, in this case, let's see. If we have the preferred stock being cumulative, this is my case in my left-hand table. So what I will see, let me grab my box real quick and then we'll look at it. So what we will see is in year 2019, of course, the full $5,000 is paid to my preferred shareholders. And that is because they are required to receive the first $9,000 in dividends anytime dividends are issued. But if this is cumulative, then they did not receive 9,000. So they should have gotten 9, they only got 5, meaning they missed out on $4,000 in the year 2019. So when the $42,000 dividend is declared in the next year, they get the $4,000 from the previous year plus the $9,000 from the current year, coming out to a total of $13,000. That means that what is left over of that $42,000 that was issued in 2020 actually goes through to my common shareholders, which is the $29,000. And so you can see the actual split here. Boom, $18,000 in total over that 2-year period going to preferred, and the $29,000 going to common. Now, if we look at the other side, we'll look at when this is non-cumulative. So when I am dealing with a non-cumulative preferred stock, they should have gotten 9,000, but they only got 5. So that 5 comes in, and because this is non-cumulative, that $4,000 they missed out on, they're just not going to get. So at this point, they come in, they now get the 9,000 of the 42, giving a total here of 14, and then the 33,000 will run through the common shareholders. So very good. Now, when we actually look at this, or when we continue looking at this, the next thing that we want to see is what is called participating versus non-participating. So you look at that and you say, well, shouldn't the preferred shareholders have gotten more? Isn't that the whole point? Well, yeah, right. So they may not be happy that they're not able to actually get any of that shareholder or any of that dividend is going to those common shareholders. So they may want a feature called participating. Right? Typically, this is non-participating, which means the dividends will be limited to a maximum each year, limited, of course, to that stated dividend rate. But if not, we can see that we have participating dividends, which means that those dividends may exceed the stated amount once common stockholders receive a dividend equal to the preferred stated rate. So, reasons for issuing preferred: we can raise money, of course, without sacrificing control, because this typically does not include voting rights. This can boost the return by common through financial leverage, because we are not increasing our common shares outstanding. And this will appeal to investors who believe the common stock is too risky, or that the expected return on that common stock is too low. So it just gives us another market to actually sell this out through. Now, the next topic that we need to look at is this idea of treasury stock. Now, I've mentioned it a few times throughout this video so far, but this is essentially when a company buys its own stock back. Now, this gets a really bad rap in the news and in the media, and we talk about stock buybacks, and we always hear it as this really negative, evil thing. But there are some actual reasons that we may do this that are not as deceitful as it is often made out to be. So when we talk about treasury stock, this is when the company buys back stock that it has once issued. So a company might need its own stock to do the following, right? It might be using those shares to buy other companies. So maybe they're trying to invest in another company to bring that into the fold, to increase production, to increase efficiency, whatever that is. They may be using those shares for that purpose. They may be doing this to avoid a hostile takeover. So if I only own 60% of my company and I start noticing that people are buying up all of these shares and they're all going to one location, then I may realize that someone is trying to actually buy me out and take over my company and get rid of me. So in that case, I start buying back those shares as fast as I can to build up this wall between us so that they can't actually take over control of my organization. Now, we can actually then use this to reissue to employees as additional compensation. So this is a good thing, of course, assuming that the company is operating healthily and ethically and is going to maintain for the future. And this can also help to maintain a strong market for my stocks, for my individual stock, for my company, which will help my actual shareholders who already own this being able to actually buy and sell this stock quickly. So there are reasons for this. Most companies do have some amount of treasury stock, and we see here that about 62% of companies do have treasury stock, while about 40% or 38% in this case do not. So most companies will have some amount of treasury stock. It's not always a ton, but they may have at least a couple of shares or a little bit in that classification. Now, what you have to realize is we are buying these shares from people who own the stock, which means I'm not going to be able to rebuy this at par necessarily. I have to buy this at the market price. So in this case, I'll come in buying treasury stock for $11.5, debiting treasury stock, which is essentially a contra equity account. It's going to go into that equity section and start to reduce that balance because it does have a debit normal balance, and I'll be crediting cash. The treasury stock is, of course, shown as a reduction in total equity on the balance sheet, and that is what we just talked about a second ago. Now, if I then decide I need to sell my treasury stock or reissue it, then what I do is I come in, I debit cash for the amount that I've reissued at. In this case, we're reissuing at the same price we bought. So cash is coming in for $11.50, and treasury stock common is going down by $11.50 with that credit, wiping it out. Now, in this case, if I sell treasury stock above cost, we'll see that on June 3rd, we sold an additional 400 shares for $12 per share. Well, in this case, we generated cash of $4,800, but you'll notice the amount coming out of treasury stock is the 1150 per share times those 400 shares. It went into treasury stock at a cost of 1150. It must come out at 1150. If it comes out at 12, you'll zero out at the wrong point. You'll still have shares of stock, but there won't be any money left assigned to that, so it won't work. So I'll have to bring it back out at that cost of 1150, reducing my treasury stock by 4,600 and resulting in paid-in capital increasing by $200. Now, if I sell my treasury stock at a price below cost, we will see that on July 10th, Cyber sold an additional 500 shares of its treasury stock at $10 per share. So 500 times 10 is $5,000. Then I will have to actually wipe out that paid-in capital that we had established in treasury stock before. So we see here that before this, we had a balance in paid-in capital treasury stock for $200. That must be cleared out. So I'll clear that out. I'll also clear out my treasury stock for the 500 times the 1150 for 5750. At that point, I see that I've got 5200 in debits, 5750 in credits, telling me I need a debit for 550, and the only place this can now come out of is retained earnings. So we have to reduce retained earnings with a debit. Very good. Now, my statement of retained earnings will have a couple of different areas of it. So we'll see that retained earnings, of course, is the cumulative amount of reported income less any net losses and dividends declared since the company began operations. So there are two different types of restrictions that I can actually see on retained earnings. The first of these is what is called a legal restriction. So most states, of course, restrict the amount of treasury stock to the amount of retained earnings. So I can't be purchasing treasury stock at the point that I'm reducing retained earnings below zero, right? That would not be good. So that is typically not allowed. And there are contractual restrictions with loan agreements that include restrictions on paying dividends once retained earnings is under a certain amount, or they may even include restrictions on repurchasing your own stock through this treasury stock process. Now, we can also see what are called prior period adjustments. So prior period adjustments are simply corrections of material errors in past year's financial statements that result in a change to the beginning balance of retained earnings. So in this case, we see that retained earnings was previously reported at $4,700. So that is what we see here. But then we realize that we incorrectly expensed land for $200, net of the $60 of income tax benefit. So we have a $200 adjustment that has to actually be made, coming out to a new beginning retained earnings balance for this next period of $4,900. At this point, I'll add in all of my current year items, my current year net income, less those current year dividends declared, coming down to a new ending retained earnings balance at the end of this period of $5,400. Now, if I look at my statement of stockholders' equity, right? So this isn't one of our formal financial statements, right? We have of course, the income statement, the statement of retained earnings, the balance sheet, statement of cash flows. So this is not one of those, but it is certainly an important statement that we do use to keep track of all of this stuff that is happening within stockholders' equity. I think at this point in this video, you can agree there's quite a few transactions that can occur. There's quite a few different ways things can happen in this area of our financial statements. So it might be good to really take a deep dive and figure out how all of this is relating. So what we'll do is we'll come in, set up our beginning balance for all of these different items that we have affecting equity. We'll then take into account all of the current year changes, and then we'll come down and find my ending balance for each category. And this will help me to make sure that everything I've done is actually operating properly and that I am accounting for everything. So it's a very good statement to be able to prepare. It is not one that I am overly concerned with in this chapter, but you certainly might have, say, a multiple choice question or something on the statement of stockholders' equity, asking you to look at it. I believe there are some questions on the homework that have you deal with this as well. So very good. Now, one of the last topics in this chapter is something you hear about all the time if you follow investing at all, right? If you turn on, say, the news for even like 3 seconds and they're talking about investments, this is something you will hear referenced almost every time, and it's called EPS, or earnings per share. So this is one of our most widely used statistics, and it's pretty easy to calculate. It's called basic EPS. There is a diluted EPS calculation that I will leave you to deal with in intermediate accounting. For a basic accounting class, for an intro class, I'm really focused just on this basic EPS calculation. And so the way we do this is we just come in and we take net income minus those preferred dividends. So this is essentially what is left for my common shareholders. So net income minus preferred dividends divided by my weighted average common shares outstanding. Now, the way we're going to calculate weighted average common shares outstanding in this class is we'll take beginning common shares outstanding plus ending divided by 2, and that'll be our weighted average. Now, in truth, there is a much more involved calculation if you start dealing with this with 12 months of data, right? So if I give you 1 month, 2 months, 3 months, right? January, February, March, here's how many shares were outstanding. Then you have to actually deal with that. But once again, that is a discussion, that is a topic for a future accounting class. Now, one of the next ratios we need to understand is called the PE ratio. This is the price earnings ratio. This ratio just tells us about the company and its relation to the stock market's expectations. So if the stock market believes the company is doing really well and is going to do well in the future, this will be really high. If the company is not doing well and the market looks at the company and says, all right, we think this was a one-off year, even if it was good, we're not really sure that the company is healthy and going to be successful going forward, then you'll have a pretty low PE ratio. Now, the way this works is we'll take my market value, what people are actually currently paying for each share of stock, and then we'll divide that by my EPS. That will tell me my price earnings ratio. How much more are people willing to pay than you generated in income this year? If it is extremely high, that means people are very optimistic. If this is very low, it means people are pretty pessimistic about the future of your organization. Now, another ratio that we need to look at here is called dividend yield. So this is where we start to once again marry up with finance a little bit, because it's a very popular formula that you'll see whenever you take finance at the university. So this will tell me the annual amount of cash dividends distributed to my common stockholders relative to my market price. So pretty easy calculation here. Annual cash dividend per share divided by, notice, my market value per share. This will give me my dividend yield, which once again is just telling us about the annual amount of cash dividends that are actually being distributed to those common stockholders relative to the stock's market price. And finally, our last area that we want to look at is called book value per common share. So in this case, we will take my stockholders' equity that is applicable, notice, to common shares divided by my common shares outstanding. So the first thing we have to do is figure out, well, what on earth is my total stockholders' equity amount? That seems like it might be a good place to start, so why don't we start there? Well, my total stockholders' equity in this case is $447,000. But I believe some of that is made up of preferred items. So this is my $100,000. Well, that isn't applicable to common, so that has to come out. And in this case, we do have dividends in arrears of $14,000 related to that preferred stock. So in this case, we'll have to back out both the 100 and the 14, giving me the equity that is actually applicable to my common shares of $333,000. I'll now need to divide this by my number of common shares outstanding, which in this case they told me was 10,000 shares. And of course, we can see that right here, my 10,000 shares issued and outstanding. So very good. Now, in this case, that gives me my book value per common share of $333 divided by 10,000, or $33.30 per share. Very good. And with that, we have officially hit the end of Chapter 11. So if you have any questions, feel free to come by my office, send me an email, drop by, meet with me by Zoom, whatever we need to do to get you caught up. I'm always happy to do it. We are here approaching the end of the semester, so make sure you're staying on top of this class and not falling behind right before your cumulative final exam. So if you have any questions, please never hesitate to reach out. I'm always happy to help you. We'll see you next time. Thank you so much.